Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on StockCharts, we'll look for long time frame trades. And please subscribe to my articles and Twitter feed for intra-week updates. Lots on there. Well, we've got ourselves a little bit of a correction starting to show up. And today what I want to cover off is why this particular situation is harder for technicians. So while other people might just think the market's having a small pullback, this is one of the most important inflection points in the market if the market is going to inflect. So we're going to walk around and I'll show you how I check the market heartbeat. Looking around the world for clues, and there's lots going on around the world. So if we wanted a reason to sell off, there's always one. But really, technical analysis, as Carl Swenlin likes to say, is a windsock and just tells us which way the wind is blowing. I want to talk about that a little bit more. So we're going to follow some money, just see what's been working, what are people buying into, the asset groups that are more growth oriented, are people picking those up? We want to use other asset classes like the bond market to help see what's going on. And one of the things that I remember really distinctly back in 2007, late 2007, early 2008, and I think it was actually early 2008, we were just kind of treading along, and all of a sudden one day the stock market fell 450 points or whatever. And in Investors Business Daily, at the time I was reading the newspaper, and one thing happened on that day, and it was, we don't know what happened, but all of a sudden the market has no support. We immediately move to caution and make sure all of your positions either have stops under them or get out. And I remember that really more from a perspective of, what was it that made them gravitate to make that statement? And I think where we're at now, obviously we've had 3 400-point Dow days in the last 3 weeks. So one on the Tuesday after Martin Luther King Day, one on last Monday, and then again yesterday. And again, we rallied off the low, but it was down 220 or something. So I think one of the things that we need to be aware of is what would be a shock value for the Dow, and is it 500 or is it Dow 600? I think what we need to be aware of is just when you have something that all of a sudden suggests there's no support in the market, and as the Dow goes up in in actual numerical value, obviously Dow 400 isn't as big a gap down as it used to be. When we were significantly lower back in 2007, 2008. So just being aware of that kind of shock value, and off the major market lows, the first December 26th, which was the day after Santa Claus, of course. So Santa Claus shows up and all of a sudden we get a 1,000-point rally. And some people were, bearish on that note. Well, okay, so we got a 1,000-point rally, look how far we've fallen. But actually it was like a significant day. We haven't had a Dow 1,000 day for a long time, and it marked a big turn in the markets. And that was a 30+ day run where we made a lot of money. So we want to be aware of those shock value days. And I think if we started to have a Dow down 500 or a Dow down 600, that should make us much more cautionary, because it would suggest extreme weakness in the market, not just a little weakness in the market. Okay, getting onto the charts, I want to show how to talk about that. And let's just expand that out. And what we see here, I got the wrong tab. That's not very good. Don't know what happened there. Okay, there's the page I want. So what we have here, this is just from your dashboard in the middle of the page is your market summary. And I'm just looking at these charts. But really briefly, I want to see, normally on big down moves, the NASDAQ underperforms. And so right now, the NASDAQ is down 0.5%, whereas the Dow Industrials are down 0.8. The New York Composite is down 0.57. So I'm seeing nothing in here that makes me really scared here. The market just looks like it wants to pull back a little bit. And again, that doesn't mean that we're off into the races. It just means that so far the market is just having an orderly pullback where everything's kind of pulling back. Talking with our video engineer this morning, and what we noticed was, this continues to be lower highs and lower lows so far. And now we're at this point where we're just checking our work to see what's going to happen. We're above both moving averages. And is the market going to fail here? So using these simple tools, you're still in a downtrend. You have to be aware of that. And it doesn't really matter which one we go to. Here's the transports. And on the transports, one of the clues that I like to look at more is the railroads. And I've got that tab opened up here, but the railroads are holding in just fine. And I keep reiterating that if the relative strength in the railroad starts to break down, then I'm much more worried. And so far that hasn't happened. So here we are back in 2015, and we start to see the railroads underperforming. So that would be something to me that says the U.S. economy is going to start having more problems, and we haven't seen that yet. So to me, it still looks like this is a small pullback, and we just want to keep watching it. Here's the overall market, so the Wilshire 5000, and look at this, we're down 0.5%. So it's not like we've got some pockets of weakness in small caps or something like that. Now, again, we're going to wait for the Friday close. Obviously, that's one of the most important days in the market. When we and I say that because people need to hold a position over the weekend, saying that everything's fine, and they're willing to hold it. So that's why a Friday close is more important. It's a daily close, a weekly close, and sometimes it's a monthly close, not in this particular case. And next Friday is options expiration day. So we need to just be attuned for that. Okay, so with the transports, we're rolling, pulling back slightly. So far, none of this looks severe, right? We've had these 2 days corrections back in late January, and that was just no big deal. Looking across our sectors, XLE continues to be a weak performer. And that is a pretty important clue, I think. The financials are one of the worst performers, which I don't like to see. That one concerns me. XLV, which is another, call it offensive growth-oriented group, still not doing well, even though we had nice results out of Coty and a few others like that. The XLB, this is weak again, and we start to see that. If we go look at just the sector summary, so this is set up over the last month. And what you see here is real estate has really taken off. So as the yields have come down, real estate's really done well. Or sorry, as the yields have gone, yields have come down and the price has gone up. And here's industrials, and they've done particularly well as technology, and this is relative to the S&P 500. So you can see all of these groups are underperforming the S&P 500, but a few of them are doing okay, and financials are basically living the average, for this lack of a better word. So that's relative to the S&P 500. If we click this button off and on, so you can see I'm up here in the left-hand corner, what this does is say, what is the total for the group? And, so you can go through and you can see industrials have really had a good solid month, right? Up 11%, nothing wrong with that. And technology, and these are on the growth side. So if we right click on the page, we can show the cycle line. And what we want in bull markets is we want this left side to be outperforming the right side. And so far we have that, right? That's pretty good. And this kind of wraps around. So this line here moves to the other side as I pull this across. When we have defensives outperforming, okay, that's more concerning. And if we slide back, obviously we could wouldn't take very much to get defensives outperforming. There we go. Something like that, where the defensives are really outperforming, and here we are in mid-December. And so it was telling us that the market's, still investing on the defensive side of things. Now, as we slide this over, things are better. The only question I would say is, out of the S&P 500 groups, 2 of them are doing very well, and nothing wrong with that. The whole thing doesn't have to perform well. But I just think in general, if you look across the sectors, the fact that lots of them are underperforming the S&P 500 is a little bit worrisome. And the fact that one of the major defensive sectors is really the top performer adds to the concern for the overall market. Okay, looking through the industries, one of them, obviously, that's always important is the semiconductor index. When we click on the semiconductor index, it's, it clearly peaked here and has pulled back a little bit for a couple of days. Nothing too urgent, but we're back below the 200-day moving average. And so we just want to be aware of this, how price reacts to the 200-day. I think that's a pretty important turning point. Here's networks. And this chart's doing exactly the opposite, trying to push to new highs, so that's more bullish. Drugs are up today, and that chart, barely getting above its moving averages, so it doesn't look like the go-to place just yet. Broker dealers are a leading index. And the problem we see again is this lower high, lower low phenomena. And this one right here, as we tested the previous high and really the high in here, because we never closed up here, we closed. This was a high close. This was a high close. So far we even have lower closes than in this range here. This was an intraday high. But we can see that these are starting to roll over. So that adds to my concern level that a broker-dealer index can't get going. Gold has been holding on hold really since the end of January, and just want to continue to monitor that one. It hasn't been great, actually, so it's been hard to watch or hard to trade because it's pulled back a little bit. Some of the gold stocks have absolutely plummeted, like Oceana Gold, but some of the other ones have held in there. Anyway, just to continue to look through the market. So we see around the world things are weak. And here's the Australia ETF. And I like to look at Australia just as a commodity supplier to the Asian markets. And you can see we've made a higher high here in this market. So that's a little bit more bullish. And emerging markets have been trying to do well as well. But here they are getting above their 200-day moving average and now giving it all back in the last couple of days. So I think this is an important inflection point. It doesn't really matter who you listen to in terms of a fundamental analyst about Asia and Europe. They'll talk about slowing growth and how things look much weaker in the emerging markets than in the U.S. market. And so their favorite market to invest in is the U.S. One of my concerns is the S&P 500 sells largely to the rest of the world. So if they're slowing, that slowly impacts the S&P 500. Okay, so here's Hong Kong, and obviously this one's going to be important as we have Robert Lighthizer and Mnuchin heading over to China to discuss more trade-related stuff, and we don't have a presidential meeting scheduled with China, so that's a bit concerning as we come towards the deadline here in a couple of weeks. In France, if we look there, they've had obviously a lot of problems, just the whole yellow vest incident and whatever. But the chart has been okay. I think the bigger issue that we have when we get into this, into the France situation is what we really want to watch for is Germany and France and England rolling over. And England looks a lot better, but Germany doesn't look quite as robust. And so this breakdown in Germany, I think, is really difficult, and the main reason for my concern there, let's just open link in a new tab. The main reason for my concern is Germany's typically got the best growth engine in Europe, and so if this is the sign for the best growth engine in Europe, that makes it much more difficult for us to get really excited about global growth. So going to a weekly chart on Germany, we didn't get anywhere near the 40-week moving average. We're rolling over. A full stochastic on a weekly chart rolling over is bearish. You can see right in here when this rolled over around 50. This is just, a river of pain that you don't want to be on. Back here in 2015, that was a very good clue. Got up to the 50 level and rolled back over, and you just kept falling. So we don't have an exit strategy here based on Germany. Just to get out of the markets or whatever. But I think this is one of the more compelling stories right now to be aware of. So I'm not looking for pain. I'm looking for support for the bull market. And again, the NASDAQ continues to perform well relative to the others, but we're seeing big things like here's India down 2%. And on that market, so it's right in here, not up here, you can see how we've traded sideways all through the last 3 months. So while the US markets rallied, this has been unable to rally. And again, the demographics are fabulous in India. But if this market can't get going with the best demographics in the developing world, I think that's a bigger problem as well. So looking around, Italy has lots of debt, and we're seeing that roll over. And again, they hadn't even started quantitative tightening in Europe. So if all of a sudden we're having problems in Europe with no quantitative tightening, what's it going to be? What can we do to keep easing the pain there? And here's Japan. Japan is pretty important globally. Normally, you'll see that Japan either supports the US breakout to the high side or kind of clues in that it's not, the move isn't going to hold. And Japan is one of the ones that I'm concerned about. I don't like it at all when it's that weak. And the other one I want to look for here is Sweden. And the reason I like Sweden is because their krona's independent and it doesn't show as much weakness. So it's okay. But normally, I think I've mentioned before, I find the Swedish krona one of the first that starts to break down. The bond market is where I want to talk about a lot. And the biggest single thing in the bond market, for most of us, if you're trading your own portfolios or whatever, you'll want to be aware of bonds. But I think most of the people trying to trade their own portfolios, I think, are trying to add a little more upside to their portfolio. Well, we can use the bond market to help tell us what's going on. And this is one of the things that I'm seeing this morning. And I mentioned it in the article last week, my weekend market review, and that was just about a textbook. Let's go get that one under the Canadian Technician. And I spent a long time on the weekend trying to build this out, and I also heard from Martin Pring. But I would encourage you to go here and check out this article. There's a lot of things going on that I think are helping us decipher the market. But one of the big things here, this is the 5-year bond or 5-year treasury note, if you want. And as what you see here is this is starting to roll over and break this big 2-year uptrend line. That, I think, is more important. And the reason that is more important is if I go find the dollar UST is what I'm looking for. Okay. Here is the 2-year, and we'll go to the 10-year in just a second. And the point I want to make here is this is rolling over. You have your RSI up here in 2000, and it got all the way to 70 and then rolled over. So that was cautionary. And it was also a place where the momentum indicator was above 0 and then failed. Here we got up here in 2006 with all of the mortgage-related boom, the housing-related boom, and we were at 2006, and we got a sell signal. And that just guided us early in 2007 that something was changing, and this started to fall apart. So now we've seen the RSI bit super strong, way up here. But now we're coming out of this overbought level. We're falling below 70. And again, you wobbled up in here as you fell below 70, and then all of a sudden it rolled down. By the way, the moving averages on here are a 10-month moving average. And then if you go to the S&P 500, and this is plotted logarithmically just to make sure. So the way you do that is put in a comma log, and that will make sure that your other plots are also logarithmic. So on a logarithmic scale, you should see it getting tighter towards the top if it's a fast-moving chart. And that means that this was a percentage move, in this case of 20%. And if you go up here, the same height would be the same move percentage-wise. Okay, so the concern obviously is that when these two rolled over, that was a clue that something else was changing. We did get a signal in 2016, and then we just turned and broke out. It wasn't a very strong signal. We were briefly up there, and then it pulled back, and then we took off. Now, I mean, it was still a 20% pullback or something into the 2016 low, so it wasn't a sneeze or no big deal. It was still significant. But anyway, we pulled out of there, and now we've come back up to the top here. And as we approach, what we want to follow on is, does this have the strength to keep going higher like this, or do we actually roll over right here and this becomes a problem? So we're below the 10-month moving averages on both the bond market and the stock market, and that's a clue. Now let's just go to the 10-year, and maybe I have that tab open. I don't have it open, but what I want to show here is the US 10-year Treasury note price, and I've ratioed the chart with the S&P 500 ETF SPY. And what that means is I want to look for which is outperforming, the bonds or the SPY. And back in 2000, what we saw is this breakout here, just moving above its moving average, 10-month, in this case, 40 weeks, so roughly the same, broke out. And then you could see that this was a pretty clear indication bonds were outperforming. And then we had a big pullback into 2007. And so even though those bond markets that I showed you earlier were topping out in 2006, the stock market was still outperforming enough that the ratio was unchanged. Well, then you got this blip in the bottom of 2007, and it started to move and then make its way higher. So we saw the same thing over here, started to move and make its way higher. Well, we've had a couple of false alarms in 2010, 2011, 2015, 16, and now this one right here. And so if we look at the momentum indicator, I think, yeah, and I plotted this as performance. You can also plot it just as regular solid line price. My point here was to show you that this pretty much mimics this, with the exception of a little bit of divergence on the indicator. When you look at these ratio charts, one of the things about a ratio chart is it'll actually swing both sides, right? So it should give us the clues a little bit earlier. And John Murphy uses them extensively, and it's for that reason that they actually start to show the swing early. So here we sit, we've broken out, and now we're pulling back. We have an RSI signal that's been strong enough that we got way back here, first touch, and it's just a clue that you're hitting a new bull market for this relationship, right? And as we pulled back, you'd see we never got up there, never got up there, never got up there, almost got up there in 2015, 16. Now we've actually got up there. So are we starting a new bull market, or is it like 2011 where it's a false alarm? We don't know. But I will say this, that normally on a stock market, you can say, okay, we're up and we're moving higher and everything's beautiful. We're down and we're going down and everything's ugly. And we're at the or part. We're right at the point where it's inflection. Does this break this way and catch a lot of people who just want to be bulls in the market offside? Or is this where we actually just get back into our big bull market? And so this ratio pretty much sitting right here, pretty much right at its 40-week moving average, slightly above. But you can see the momentum is starting to roll over on this signal. It did that back in here too. It did that all the way back in here in 2008, rolled over and started to say no big deal, and then boom, off to the races. So we don't have the answer, but I will say that this is the trickier part of the market when we're at these inflection points. And, 2015, 2016 was right there. We came back to the line. We broke out here and we rolled under here. So now we're watching. We have to just be cautious because we're at one of those major inflection points in the market. Okay, so hopefully that explains why I'm more cautious this week. I'm not really out here saying, here's the new bull market and all the stuff to buy. The semiconductor starting to roll over doesn't make me feel warm and fuzzy by any stretch. I would just say my biggest encouragement is the railroads continue to outperform, and that's very helpful. Trying to, make new higher highs here going back through the October-November timeframe. And this will be the highest close going back all the way into October. So that's pretty good. And our PPO is just coming above zero. So if it was to roll over right now, and we're on quite low volume so far, if it was to roll over right now, that would be much more concerning. So I continue to watch those things. But again, this is not the week where I just want to say, oh, get long and don't worry about it. We're at the 200-day moving average, which was written about in this article. If you don't understand, Dave Keller also posted an article this week. You could find it through his Twitter feed. Other people don't use their 200-day moving average, and we were talking about that on Twitter this week. But I think everybody has different tools in their shed. One of the tools I like to use is the moving averages, and the 200 is a pretty big deal for me. Okay, just to focus in on the semiconductor index, this is obviously one of the high growth areas. And when you see this, right, this is just chopped sideways. We move below the 200-day moving average. We come back down. We're trying to get back above it. We spend a couple of days there and fail. This is a very important inflection point. We see this quite commonly, that you barely get through the 200-day and then it rolls back over. If we just unwind this chart for whatever, 5 or 10 years, let's just put even 15 years on here. And when this chart goes, we got too many moving averages, so let's just make it none, and we're going to make it a solid line instead so the data is easier to read. When we get this breakdown below the 200 and coming back up to it on something important, look at how good the timing was here in 2015, broke below. Here we are, late 2015, couldn't get through it, fell back down. The semiconductor index here back in 2008 rolled over right at this point. These are very good places to watch for clues. So I want to keep being aware of growth markets like the semiconductors, growth markets like the broker dealers are one of the leading indicators. They can help. I wasn't happy to see Goodyear tire chart breaking down hard today. Those are starting to worry for the automotive industry if they're going to get a pullback. But the railroads are still holding in there. And so as long as that railroad inflection point says local stuff in the U.S. is okay, and that the industrials continue to perform well in the U.S., I think that's helpful. Obviously, technology is a big one, and biotech and biotech shows up over in healthcare, but in the technology space itself, with some of the big names we've been following for years, we just want to watch and see if this can continue to lead the storm higher. So again, as we wrap up here today, just go back to these markets and try to keep track of which ones are starting to break out. If we start to see Dow 600 and Dow 500, that would suggest to me that we're resuming the downtrend. That's going to basically say the market doesn't have enough support, and any brief rally after that should probably be sold into. That would be something that I would be watching for. I mentioned last week that I kind of got scared out of the market. Now we're just back to kind of where I got scared out. My point is we're at a high risk zone, and the big issue is to make sure that you're prepared for both outcomes. If the market starts to reverse and move to the upside, then I want to participate. But if it fails here, this would be very predictable based on the historical moves within the equity market. Lastly, just try and maintain your ballast through the charts. Try to use the charts to help you see what's going on. I think that's more important than the news cycle. Thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern, 7:30 a.m. Pacific on StockCharts TV. You can also catch replays on the StockCharts YouTube channel or on StockCharts TV, which has a running list of technical charting informational shows. This video will show you how to add a date line to your charts. So if you have a whole bunch of stuff piled up here and you want a date line farther down, there is a way to put it on there and how to move it. So down here under indicators, it's one of the options, date time axis, and by just moving it up and down with these triangle arrows, and notice this little blue arrow that moves with it, it'll help you position it exactly where you want it.